Refinance season is on the way. I am so excited because, baby, oh my God, this has been a hard year. This has been a hard, long 12 months of interest rates going up and up and up and up. But things are starting to turn around. So interest rates have steadily been decreasing for the last several weeks. And I want to talk to you a little bit about what you need to do to prepare yourself to refinance your home. So I've noticed, because I spent a lot of time on Instagram, I've noticed that people were saying, was it marry the house and date the rate? Well, the idea of saying to buy the house and date the rate means you don't have to keep that interest rate. Well, unfortunately, I think that was something that was presented incorrectly. So I want to talk to y'all about what exactly it is that you're going to need to be able to do to refinance your home loan. So quite frankly, some of y'all ain't gonna be able to refinance. And it's just because whenever you refinance, if you've never been through the process, you're effectively buying the house from yourself. So you're qualifying for a loan to replace the loan that you currently have. So even though in your mind, you're like, I've been making my payments on time, I haven't been late, and what's the problem? Because my payment is lower. They have to re-underwrite your current risk because the investor is going to be somebody different. And so they need to know that your life today is good enough or intact enough for them to expect an on-time payment, roughly for the next 36 months. So first of all, what do you need to do to be able to refinance a home loan? So if you have a conventional home loan, you need to make sure that your debt to income ratio is not going to be over 50%. That means you hopefully didn't go out and, spend a lot of money on, credit cards for furniture and refrigerators and all of, a lot of the things that you have to initially invest in whenever you move into your new home. So hopefully you don't have, high credit debt that has caused your debt ratio to go, out of whack. 2, you haven't purchased a new car or you haven't, increased whatever car payment you did have. If anything, you want to make sure that your payments on all of your debts have gone down. 3, have you gotten into the house and then decided, okay, I got my house, I'm self-employed now? If that's the case, go ahead and get to the back of the line, because I'm going to tell you now, you need to wait 2 years, and we need to have 2 years of tax returns before you're going to be able to qualify for a conventional loan if you're going to refinance. Another thing is that I think I want to point out that's really important is it's a little bit different when you refinance versus when you purchase, because the amount of money that you had to come out, like your bank account, you don't need to write a check at closing whenever you're refinancing. We'll just put the money back into the loan. So hopefully, if you are someone that purchased a home and your home values have increased, which has been roughly 10% from last year to this year nationwide. Obviously, there are going to be very small pockets that have appreciated a little bit less. But if you have appreciated, you'll find that you will have enough equity in the property to be able to roll some of those costs in. If you do not have equity in the property, then you may need to write a check up front for the closing costs that are associated with your refinance. So let's talk about that. What are the closing costs that are going to be associated with the refinance? Most lenders are going to charge a lender's fee. Even if you go back to the same lender, different lenders function a little bit differently. So you may find that if you go to the same lender that did your loan when you purchased, they might waive those origination fees, but they cannot waive all of your fees. So if somebody says, oh, there are no fees, they're lying, because they don't have control over the title company or the attorney's fees, because they need to do another title check just to make sure that you don't have any liens that have been placed on the property. So there's nothing they can do about that. The other part of the fees, which you may or may not have, is, they're going to evaluate where you are with your escrow. So if you change lenders, they might not be able to roll your escrows back into the loan. Well, they can roll it into the loan, but what I mean is they may not be able to give you credit for the money you already paid. So for example, let's say, your taxes and insurance is $3,000 and you've already paid, ABC lender $3,000, but you want to refinance with XYZ lender. You're going to have to roll whatever your escrow amount is into the loan for where you are year to date. And then you'll wait another 3 weeks or so after the loan has closed. And then they'll send you a check. The original lender will send you a check back in the mail for whatever that amount is. Now, if you want to take that money and you want to go shopping or something, go off. Or if you are more like a lot of people, most people, they want to make sure that the loan amount is going down. So you could just throw that back onto the principal of your loan and you'll see that that loan amount will immediately go down. Another thing that I find when we start talking about refinances is there is a difference in requirements between refinancing a government loan and a conventional loan. So pretty much everything I just said was for a conventional loan. So now let's talk about government loans. If you have a VA loan or an FHA loan, you'll be able to do something called a streamline. So basically a streamline is where we're not really going to be checking for like income, assets, debt to income ratio. And I'm being very loose in what I'm saying, but effectively your hurdle is significantly lower. As long as your interest rate is going down or your payment is going down, then most lenders will allow you to go ahead and move forward with the refinance without having to reprove your income or reprove your debt to income ratio is low. You will still be in a FHA or in a VA loan, and with FHA you will still have the mortgage insurance, but you'll have the mortgage insurance with a lower interest rate or a lower payment. So that could make the difference in hundreds of dollars a month, but again, you will still have to have the mortgage insurance. So that's pretty much everything. Just want you to know it's not as advertised. Like I said, the whole married house date the rate, it was cute. A lot of people said it. I didn't really hop on the bandwagon with that because I already know that it's far more complex than just making a statement that's real cutesy wootsy and rhymes. You have got to be able to qualify if you want a lower interest rate. Make sure, something I left out. If for some reason you need to take somebody off of your loan, you have to requalify all over again as well, even if it is for a FHA or a VA loan. So if you applied last year with your boyfriend or your girlfriend and now y'all broke up and you think, I'm gonna get a lower rate, I'm just gonna do a streamline. No, you can't just have them taken off. You are going to have to requalify to make sure that you all by yourself will be able to support whatever that payment is. I would love to hear from you if you guys got any questions, comments. I'm happy to answer your questions, go over your scenario with you. All of my contact information will be below. I look forward to helping you. Y'all have a great day.